Well, we've certainly had a lot of major global events over the last few weeks. The oil price now up 24% as a result of the unrest in northern Africa. And of course we've seen the tragic earthquakes in Japan. From the perspective of the Australian share market, it's meant the market's lost about 3% in level. The US market has been highly volatile. The VIX, the measure of volatility, was up at a level of about 30 last week. It's now down to a fairly sedate 20, so things seem to be settling down, and the losses the US market has made have been pretty much regained. The outlook for the growth of our major trading partners, given that Japan is a critical factor there, we were expecting them to grow by about 5% over the annualised in the first half of this year. It's now looking like about 3.5% given the likely contraction in Japan. However, in the second half of the year, the 5% we're expecting is being upgraded to 6.5%. So the profile will be that the rebuilding will certainly be a big positive for Australia in terms of iron ore and base metals, but base metals in particular will be affected during the time that the economy is in contraction and before the actual rebuilding occurs. As far as coal is concerned, that will be a beneficiary all the way through, particularly at the time when Japan needs to replace nuclear energy with coal. However, the problem for the Australian coal industry is that it's pretty much working at full capacity now. So while I think we would like to do greater exports, I think it's unlikely that will be able to happen. Over the last couple of weeks, I've been travelling quite a lot. I was in the US and I was in China and Hong Kong last week. A couple of key factors for equity markets that I think are quite relevant. As far as the US is concerned, the big issue is going to be when the Federal Reserve withdraws from the US bond market. The major buyers of US bonds in recent times have been China, Japan and the US Federal Reserve. Japan is likely to buy less given the need to finance their rebuilding, and the Federal Reserve of course will be withdrawing entirely from the market at the end of June. That says to me that interest rates are going to be rising quite sharply in the US around about that time, which is likely to have a flow-on effect to the US equity market. However, I think that within 3 months the Federal Reserve will have to re-enter the market to buy bonds again, and that will have a settling effect on the equity market. The other big force is in China, and many of my discussions with customers both in China and Hong Kong emphasise the strong commitment by the Chinese authorities to tightening liquidity through the banking system. That suggests to me that growth in China is going to slow from the 10% pace we've been used to about 8%, and that will have a negative impact upon commodity prices and is likely to have a downward effect on the Australian dollar and likely to have an impact upon resource stocks as well. But that's something for the second half of this year and into next year. Finally, Australian interest rates. The market unwisely panicked, I believe, last week in predicting that because of the Japanese earthquake, interest rates would be cut in Australia. The impact of Japan, as we discussed, on the growth profile is quite minimal from my perspective. The big issue is really the fact that the mining boom will continue, and the cautious consumer who's been making room for the mining boom in terms of drawing on capacity is likely to remain cautious for much of this year. That suggests to me that interest rates are only likely to go up by 125 basis point this year. Next year I think we'll have some further rate hikes, but the outlook this year seems to be quite benign. Thank you.